Paul Cavey, thanks very much indeed for joining us. Well, what do you really at the moment make of all the data here? What sort of picture is it drawing for you?
Well, I think overall the data that we're seeing coming out of China has all been rather mixed in recent months. For us, we'd be more concerned about a slowdown in growth, and that's seen very clearly in particularly the PMI numbers, which we've been expecting to fall below 50. We've got one of them below that, the other one has been falling in that direction. Things like heavy truck sales are down 30% year-on-year, excavator sales have slowed down quite sharply. And to us, this is all the end result of all of the monetary policy tightening that China has been doing, particularly focused on quantitative restrictions in the economy, which reduce the amount of money available and cause quite a lot of financial stress. Having said that, some of the macro data we're seeing are still pretty strong. And if we look at the conference board number today, but in particular the GDP number is obviously quite high, and most significantly perhaps is the construction numbers. And when we look at housing starts in China, they're still running at about growth of about 30% year-on-year, which is pretty impressive given the very high base we have for growth last year. So overall, I think the numbers are still a little bit mixed, but we're still more worried about the downside risk to growth over the course of the next few months, because monetary policy, which I've just talked about, it works with a lag. So we're really only just really beginning to see the effects of the policy tightening that began in January this year. They're only just right now beginning to feed through into the overall economy.
Is it really the case that we're going to see, 8% growth or thereabouts, and that would represent a soft landing? And also, are they done at the moment in terms of tightening?
Well, in terms of growth, I mean, 8% would be pretty bearish, I imagine, for most people right now in China, given that growth in the first half is still about 9.5%. And so the critical thing for now is does it fall below 9% during the second half of the year? In terms of tightening, that's where we would see things, and for a couple of reasons. First of all, I think monetary conditions are about as tight as you can make them in China. And one indicator we like to look at is that the confidence index from MNI, which has an index of credit availability, that's fallen off quite sharply in recent months. We'll get a next update out on Friday this week, so that's something well worth keeping an eye on. But those credit restrictions are so tight that it's difficult to see in any meaningful sense how monetary policy can actually get any tighter than it is right now. That doesn't necessarily mean that interest rates for depositors can't go up, because they still remain very low. But interest rates play a very different role in China's economy to where they play in advanced economies, because those interest rates are only really used to control the flow of deposits in and out of the banking sector. They're not really a motivator of growth in the economy overall. And in that sense, when we look at the deposit figures, they've been a bit volatile over the course of the last couple of months. They did fall a lot in July, but they increased a lot in June. And overall, it doesn't seem to us there's a lot of pressure right now in China to raise interest rates. There's a lot of talk about inflationary expectations and real interest rates being too low. But real interest rates, to our mind, they're not really being manifested in the economy in terms of boosting another re-acceleration and stimulating growth. And therefore, we would imagine that interest rates aren't going to rise anymore for the time being, but probably go up again in 2012.
Yeah, Paul, what about the way that they've been managing the RMB of late, giving it a bit more freedom, and is that another way of tightening in a way?
Yeah, I mean, it's very interesting, obviously, that happened particularly last week, when everything in the rest of the world would be suggesting that, China would be quite worried about appreciating the currency and have anything that even smells of tightening. And so the increase in the renminbi we saw last week was interesting. Now, again, it would seem to me that it's going to be much easier for China politically, in terms of domestic politics, to change the renminbi rather than to raise interest rates. The simple reason for that is domestic politics, that we know state-owned enterprises and local governments have borrowed a lot from the banks over the course of the last couple of years. In an inflationary environment, the government has to do something to tighten policy. All of these big politically important entities are going to be very against interest rates rising, because it's going to make paying back their loans even more difficult. At the same time, obviously, a lot of the SOEs in China, they're very keen on making very big foreign investments in the rest of the world. So given this, they will have a great incentive in the currency rising rather than interest rates going up. And that's even without considering the international things that we've been seeing playing out. Obviously, the Fed's promised to keep interest rates low until 2013. The domestic backlash we're seeing a little bit against holding of US debt when it's not seen as being particularly secure. So all of these factors, I think, point very much towards the renminbi playing a more important role in controlling inflation over the course of the next couple of years. Having said that, the surprising of the move last week was surprising because of the volatility in the rest of the world. But as a medium-term story, I think renminbi appreciation is something that should be more important.
Paul Cavey, thanks so much for your time. Paul Cavey there from Macquarie Securities, taking a look at the state of play with the Chinese economy at the focus.